Okay, well, Mark Matthews of Bank Julius Baer and Company is now joining us to take us through what he's making of things. Mark, good to have you with us here. Thanks very much. You know, the 10-year in the U.S. is back at about close to 4.2. You've got the dollar index rising a little bit, 103. You've got oil prices, which are looking like they want to go up, at least not down. Is the global setup looking a little tricky, even as, you know, on the economy front, things are looking just fine, even in the U.S.? Go on.
Prashant, yes, I concur with what you said, and I would add to that we're in the dog days of summer, so we're paying back for those exceptionally strong numbers that we had in June and July. The volumes are thin in the market because many people are still away on holiday. The results are largely behind us, and the results season, although on average companies beat expectations, we can see that the market was nonplussed with that because going into the results, expectations were very low. And I just don't see many catalysts going forward. So to add on to what you said, I would state those things. And summing it all up, I think short term, we're more likely to drift than go up.
How would you determine short term? Do you think it's going to last 1 or 2 months? What would be the trigger which will get us out of this range?
There could be all sorts of triggers, but if I had to choose one thing which is responsible for the market pullback, I think it's the strength of the U.S. economy. And we're likely to see a continuation of strong numbers. Most notably, the July retail sales will be announced tomorrow. And I think the market is only looking for a 0.4% month-on-month increase, excluding autos. But looking at more high-frequency data, it could be as high as 0.7% month-on-month. So the strength of the economy is why bond yields have risen from 3.8 to, as you pointed out, 4.2% over the last 30 days, and the dollar has strengthened. And until we see signs of the economy ebbing, I think the market will increasingly take the view that rates are going to stay high well into next year.
All right. Hi, Mark. Good morning. Since the U.S. economy is so strong, then you believe that the Fed will keep rates higher for longer and no chance of a cut. So I wanted to comment on how do you see the Fed moving from here? And the second point is, since we had our RBI policy last week, it was viewed as a bit of a hawkish pause. How did you read it?
To be honest, Nigel, I was on holiday last week, so I can't respond to your question on the RBI.
So let's talk about the Fed then.
The Federal Reserve. They are data dependent. So if this data does remain so surprisingly robust, then I think it is safe to assume that rates won't come down until well into the middle or even second half of next year. I suppose the only good thing to say is that it shows the strength of the economy that you can have a 5% rise in interest rates and skirt a recession. I actually think that on the whole, it's a positive signal, but higher rates, of course, do mean that there's greater competition for the stock market than if interest rates were trending down.
Mark, that's the big question, isn't it? Can you have a situation where it's so easy that there is no price to be paid for the biggest inflation surprise in the U.S. in the last 50 years, and it all goes away very neatly, very nicely, or you think it'll be something else by the end of the year?
Well, you may have seen these research reports that have been coming out showing that even if we trundle along at 0% month-on-month increase in the headline U.S. CPI over the next 6 months between now and say the end of the year, even if we assume flat month-on-month CPI, which it won't be, it'll be positive. You'd still have the headline CPI on a year-on-year basis, something around 3.5% by the end of this year, which of course is well above what the Fed's 2% target is. So I think that the inflation is sort of getting sticky here and less likely to continue its downward trend. I guess we had all been anticipating inflation to come down because we thought the economy was going to slow down, and that's simply not happening.
Mark, pleasure having you here. Thank you very much for joining in. We need to get into a very short break. On the other side, we'll talk about stocks. Our list of top stocks is lined up next.